first like to just direct you to my website, J. Taylor Media. That's the best place to go to follow all that I do, including my weekly radio shows. You can download the podcast. It is a live radio show that occurs every Tuesday at the Voice America Business Channel. And my radio show is every Tuesday between West Coast time between 12 and 1. To give you an example, my guest next week will be Doug Casey. And I had a lot of other, Jim Rogers last week. You can go back and listen to those podcasts at J. Taylor Media. Click on the podcast page. Now, I also publish a newsletter since 1981. As a matter of fact, I was just remembering that the first time I came to Vancouver was about 1982, and I stayed in this very hotel. It was a lot different then, but it was my first introduction to Vancouver, and I thought, what a beautiful place this is. There weren't any skyscrapers to speak of at that time, but it was just such a lovely town, and obviously a lot of other people have figured that out too in the meantime. But in any event, this is my monthly newsletter. I publish weekly as well, and I have a monthly newsletter, and would like to invite you to take a trial subscription. Actually, you can, in your brochures when you came in here, all the newsletter writers are offering special rates to try their services, so I would encourage you to do that. For 3 months, you can get for $45. I think it's pretty good, 33% off the regular price. So, putting the promotions aside, my newsletter last month was titled Gold's Ultimate Price, Think Niagara Falls Through a Garden Hose. Actually, I titled that after having talked to Doug Casey, and I pre-recorded Doug for my show next Tuesday. And Doug actually talked about what it's going to be like for the junior mining companies when the demand is switched on, that there is just not going to be enough supply. Eric Coffin talked about it a little bit. Brent Cook talked about there's not going to be enough supply of good companies. I would suggest there's not going to be enough supply of companies with gold in their names to go around, and we're likely to see an explosion in the price of these shares. I think we've started to see it already. But also with respect to gold itself, I think has tremendous upside, because I am quite convinced that we have seen a fictitious gold price, a gold price that's based on massive volumes of paper purchases of gold. That is, people believe they own gold, but in fact they only own paper, something like 300 or 400 times, or at least 100 times more paper volume than actually physical volume on the LBMA. And so this has been going on for some time, and I'm quite convinced that the real price of gold for the physical offtake is much higher than what is quoted. Now, this kind of extreme rhetoric, like my friend Doug Casey has given and reiterated his views, really has been relegated to us crazy gold bugs for the most part. But now I would suggest there's a lot of other people that are mainstream people that are starting to really express some concerns of almost apocalyptic in nature. And so I want to just mention some of the things that have been said by Stan Druckenmiller, a very famous hedge fund manager who, along with George Soros, broke the Bank of England. Peter Fisher at BlackRock, and also Matt King at Citigroup. I'm just going to pass along a couple of their remarks here to give you a sense that now the mainstream is shifting. I think what we're starting to see is a shift in the sentiment, new money coming into the sector, and I think we're just starting to see a little bit of that in the last few weeks. So Druckenmiller, as I say, he's very well known, very successful fellow. At the recent conference in New York on May 16th, he suggested that people should really get out of stocks and buy gold. And he says really the Fed is really clueless. It doesn't really know what it's doing. Druckenmiller talked about 1981. He says, where would you want to be in 1981? The last place you'd want to be is in gold. And the reason was because we had 15% interest rates. Volcker took his foot off the gas pedal and allowed interest rates to rise. And I remember it very well because my first mortgage was a 17.5% mortgage in New York City. So I lived through those days. But what it did was build up capital, real capital. People saved for obvious reasons. And so then that set the table for a glorious bull market in equities and bonds, especially bonds and treasuries, over the next 2-3 decades. But what Druckenmiller is saying is now we have exactly the opposite. We have a situation where it's excessively easy and interest rates, and really it's the destruction of capital itself, because if you don't allow capital to be priced, you don't allow price discovery for capital, how can capital exist? How can it survive? And in fact, it's not. We're seeing the destruction, in my view, of capitalism, real, true, honest capitalism. But a few of Druckenmiller's slides here. The best is behind us. He's saying that, and this is just what I was talking about. Interest rates were sky high, in 1981. And you see what result. You had this tremendous run in the S&P 500 and then stocks in general, and U.S. Treasuries, started the decline in the bull market, super bull market in Treasuries, decline in rates that has persisted up to this point in time. No more room to increase leverage. This is debt to GDP, and you can just see what's happened. Look at it compared to the 1930s. 1932 was the other extreme. But this is far greater than 1932 because we went off the gold standard. There was no limit to the amount of debt money that could be created out of thin air. And so the politicians have gone to it, promising everybody all kinds of things and engaging, of course, the United States engaging in endless wars around the globe, which is why we went off the gold standard in '71. Nixon wanted to have the Vietnam War. We wanted to have socialism, Johnson's Great Society. And so, but the politicians wouldn't tell us that we had to pay for it. They just simply issued debt. And de Gaulle said, I don't want any of your stinking dollars. Give me the real thing. Give me gold, which he was entitled to do. So gold left the U.S. Treasury en masse, and that's when Nixon said, well, to hell with you, de Gaulle. We're the United States of America. We're going to close the gold window. So from that time on, we've had this explosion of credit that is leading, I think, to disastrous results, unfortunately, as we move forward. But here's just a couple of more slides from Druckenmiller. This is really showing that this is really a chart of the Taylor rule, which suggested that as interest rates or as inflation rises by 1%, interest rates should rise slightly more than 1%. So it certainly makes a lot of sense, and for a while, to a certain extent, it seemed as though the Fed was following that. But you'll notice there at the lower left corner, during Volcker's time, there was an extreme contraction or extreme difficulty. It was a tight period of tight monetary policy that led to those extremely high interest rates. But now we have exactly the opposite under the Bernanke-Yellen regime. Another thing is that we're seeing a peak now in profits as measured by EBITDA. And we're seeing the debt surge. This is non-financials, and this was Societe Generale's data that they put out. And again, U.S. corporate debt has not been very productive. I think Gwen Preston mentioned this in her talk about how the stock market has been held up to a very great extent by cheap money, companies borrowing, putting themselves in debt, pumping up their share prices, and no doubt a lot of CEOs getting out and exercising their options and warrants at the same time, and keeping the party going a little longer, but at what cost? And this slide shows the amount of money that was put into buybacks as opposed to what went into capital expenditures that would allow you to expand and grow the economy. Another concern of Druckenmiller is this, what he calls zombie lending to China. And the thing is, it's like, I think this is not just China, this is the whole world. That as we've gotten addicted to this narcotic, this monetary narcotic of easy money, we can't stop. Every time we want to stop, it creates too much pain, and the politicians aren't willing to put up with that pain. And so this is, I think, has dire consequences because it's always about taking the easy way out in the short run, kicking the can down the road. But ultimately, then, the correction is going to be all the greater when it can no longer be resisted. Without China restructuring, Druckenmiller notes that we're just not going to get this capital expansion from the emerging markets that we've seen before. So they really need to do the hard thing, but they can't, politically probably can't. So we're on a one-way street, it seems, with this enormous amount malinvestment continuing on. Peter Fisher of BlackRock, also another I would consider very much an insider. And Peter is just saying that the Fed just doesn't want to admit that they run out of ammunition, and they're trying to pretend that they still have control. But they don't have control, and they're doing crazier and crazier things to try to keep the people believing that they have control. It's really all a con game. And he noticed that there's just no way that this can succeed. Lowering interest rates, as we're doing, is really a race to the bottom, much as the 1930s, when countries were forced to. They were all trying to beat each other out the door in competitive devaluation, and the IMF, in fact, was created to try to keep that very thing from happening. But pushing rates down is just really, it discourages lending from the banks, because the banks' profit margin, if you lower the yield curve and you have zero interest rates or negative rates on the short end of the yield curve, there's no profit margin from the banks who borrow short, lend long. So you're not going to get the lending that you need to grow the economy either. And what he's saying is Paul Krugman and folks like that are just simply forgetting that, in fact, there is a supply side in this game as well. And if you don't give the banks some juice for their lending, they're not going to lend. Bolstering asset prices by lowering rates only serves to produce the opposite of wealth effect. Well, because people aren't getting rates, they're not getting interest rates, so they're not spending their money, and they're really hunkering down as well and just not spending. So, Citicorp has an analyst named Matt King who's expressed serious reservations about the existing situation as well. Anyway, he's concerned about extreme events are really becoming more and more prominent, more and more of an issue. And he's also expressing concerns about the increasing helplessness and cluelessness of central bankers, very much similar to what Peter Fisher was concerned about. So gold price manipulation, none other than Jim Rickards expressed this on a recent interview at Kitco. And again, it's this barrage of paper supply that keeps driving the prices down. So when you look at Kitco and see that price, realize it's probably not the actual price for the physical bullion. It's a virtual market, essentially, not a true market for the bullion. But he's talking about, I think Brian London talked about this a little bit too, the $1,250 gold, that really, Rickards thinks that China wants to see lower price gold so they can continue to accumulate as much as possible. And then on the other hand, the IMF and the world leaders in the West think that China should have more gold, and their goal really is to go to an SDR system that's based on gold and other currencies. And so, in other words, a one world monetary system that replaces the dollar regime that we have right now. He's maintaining that we still have a de facto gold-backed system, and that and the confidence in the system is still based on this understanding, this knowledge. I remember my son came home from 5th grade and he's telling me, "Dad, we still are on a gold standard." His teacher actually thought that we were. So I think even though we went off a gold standard, people have this concept that the dollar somehow has some backing to it. And so, but the notion, and then the people are waking up around the world that the dollar isn't as good as gold, and so it's a con game, really, is what we're talking about. So these are some opinions of insiders that are starting to sort of express apocalyptic views of the world. But what are the markets telling us? And for that reason, I do like to pay some attention to technical analysts, and one that I have on my show frequently, almost every week, is Michael Oliver, a very seasoned analyst who had worked for Wachovia and a number of other large institutions, and now is selling his services to smaller hedge funds and the like. But he's convinced that we are seeing the end of the dollar bull market. That his structural analysis, what I like about it is it's his momentum, proprietary momentum indices usually is ahead of the game and predicts price very accurately. He's done very, very well with that. And so he thinks that the dollar's days are numbered. He thinks we could see 95 on the index, but then he thinks we're headed south and significantly south. And gold he's done very well on gold. He is really now looking at something on the order of 1450 to 1470 is the first serious resistance level for gold. And I think a lot of people in this room would be very happy with that. But he doesn't believe by any means that that's the end of the bull market. Michael is a very objective. I think most technical analysts tend to be more so than some of us other guys, but you know, it's all baked in the price. Of course, is the manipulation based in the price, baked in the price? It's another issue. I'd like to go back to a quote from Druckenmiller. He ended his speech in New York by saying, on a final note, what was the one asset you did not want to own when I started Duquesne, that's his hedge fund, in 1981? Hint, it has traded for 5,000 years and for the first time has a positive carry in many parts of the globe, as bankers are now experimenting with the absurd notion of negative interest rates. Some regard it as a metal. We regard it as a currency, and it remains our largest currency allocation. And that's coming from the guy who teamed up with George Soros to bankrupt the Bank of England. So, you know, most people sort of think inflation, good thing to own some gold. And yes, gold retains its value in inflation, but gold also provides protection in a deflation. And we are still in a debt deleveraging, debt deflation period of time, I believe, a very significant one. And that's what the central bankers are trying to fight. They're trying to get out from under this horrible debt. But the more they issue more debt money, the deeper they dig themselves into a hole. The point of this slide from John Exter is that when you have this, the items at the top of this inverted pyramid are the ones that get sold. The more risky assets, the things you don't have to have, and then everybody scrambles for liquidity, and the ultimate liquidity is gold. Right before that, treasuries and paper and actual fiat money is the last thing before gold. So we're seeing the race to safety, the move to safety on bad days, when the equity markets go down, bonds, treasuries still go up, and gold tends to go along with it to a certain extent. I might tell you that Michael Oliver has recently now starting to warm to the idea we're getting very close to a turn in the treasury market. So we've had a 30-plus year bull market in treasuries, and I think that would be the big one. If we start to see the U.S. Treasury market going, then where else is the flight to safety going to go? Now, I'm going to just talk briefly about Dr. Quinton Henning and his company Novo Resources, because it is a company that I follow more than any other, probably spend more time looking at this and talk more about it in my newsletter than any other. Dr. Henning was, of course, a colleague of Brent Cook at one time, worked and wrote the newsletter with Brent. He had this idea that he first of all, he worked with Newmont, and one of his tasks at Newmont was to look for the next Witwatersrand deposit. The Witwatersrand deposit has had something like a third to a half of all the gold that has ever been mined by human beings. And so Quinton's idea was, how could there be so much gold in one place? And so he's come up with this theory that, in fact, it was a precipitation event that occurred at the time that photosynthesis started to appear and oxygen started to appear in the Earth's environment, thereby enabling the precipitation of gold out of seawater into certain specific areas that would be target areas. And the one he's targeted is Beaton's Creek, an area in northwestern Australia. And I think the proof of concept is there. It's a very exciting story. I don't have time to get into it, nor should I, because they're not here, but Dr. Quinton Henning would have been here today, except that he is very busy in Australia right now. But just to give you an idea, to show you the WITS deposits relative to the Carlin Trend gold deposit, gold that's come out of the Carlin Trend relative to the WITS, for example. I mean, it's just amazing how there could be so much gold in one place. I'm going to flip through these slides because I'm running out of time. These are some of the places that he was related to Quinton's story. So the big question, I think there's no doubt in my mind that we're in a new gold bull market. The question is, will it be a peaceful and orderly market or a chaotic one? Will it be like, trying to force Niagara Falls through a garden hose? And that would be the worst kind of situation because confidence would be lost. You wouldn't have time to adjust, and the masses won't have time to adjust. We don't know which way it will go, but that's the reason you want to protect yourself now. But decades of monetary interference definitely has caused tremendous dislocations in the market, and I think we're about to pay a tremendous price for that. Again, the LBMA is now facing some competition from the Shanghai exchange, which is a 100% bullion exchange. It's no BS paper, it's bullion. And so I think this is a very important thing to keep in mind. Might really actually cause the guys that are playing the paper game to scramble. There's not enough gold to meet the Chinese demand. Jim Rickards talked about that in his recent interview at Kitco. And I think also there's geopolitical events that are really worth watching here too. This new Silk Road, I talked to Jimmy Rogers on my show 2 weeks ago, and he verified what another guest of mine has been telling me. This is a very significant event that's taking place with China being able, the railroad that will go from China through Russia and India and all the way to Europe. And Jimmy Rogers said that, yes, it's very important. He verified, he says, I live in Singapore, and Singapore is a great port city. This is going to make Singapore a lot less important in the future as a port city. So we're seeing China and Russia, and these, some of those countries that are aligned with them, that are starting to use their own trading. They're ignoring the dollar. They're actually using, Russia's selling some of its oil to China for gold. They're both building up their gold reserves like mad, I think because they see this as the one way to compete against the United States that has a superior military. But if the confidence is lost in the dollar, the empire cannot remain. And this is, I think, this is what we don't want to wish for. Gold will go, it would be like water, like Niagara Falls going through a garden hose, but we don't want to see that. Hopefully we'll have a peaceful move, and I think we're starting to see, we're definitely in a bull market in gold, in my view. I don't think there's any question about that. Well, now I'm out of time. Some of the suggestions of companies that I've had, that I've suggested come to this show, and Eric and Scott agreed. Vino Silver and Gold, which you heard from yesterday. Golden Rain, which will talk to us in a few minutes. Klondike Gold, which comes on next to tell their story. And Tri-Metals Mining as well is going to be telling their story right now, in fact. There's a whole lot of other companies that I think I counted 13 companies that are here that are on my newsletter. So I hope that you'll consider subscribing. But in any event, I wish you all the best.